Hello and welcome back. Today we're going to look at the income statement. It goes by a couple of different names. You can call it the trading account, the profit and loss account. Where it differs completely from the balance sheet is that the balance sheet is a report of your business's financial situation at a very specific point in time. So the example that we gave in the previous video was as at the 31st of December, the year 2000. Now, an income statement is giving you your trading results over a period of time. And normally, is specifically for tax purposes, this would be for a whole financial year. All right. So to match it with the balance sheet is what we'd say with the trading statement. These are your trading results for the year ended 31st December 2000. So it's completely different. It's taking you over a period of time. And it's comparing very simply your income against your expenses. And as a result of that, you're either going to make a profit or a loss situation. Now, if you sit and you think about things logically, is when you're trading, say anybody in their own life, but let's talk specifically about Bob. We're going to keep with Bob. Is the very first thing that you want to happen when you're running your own business is your bank balance just goes up and up and up. It gets bigger and bigger and bigger. I mean, that's the simplest result that you could ever wish for by running your own business. And if, let's say, all of the numbers basically stayed the same in the balance sheet, but this indeed happened, is that Bob's bank balance after he traded for a year got a whole lot bigger. Let's say it became $100,000. I know it's a ridiculous situation, but I'm trying to just keep things simple at the moment. How would the balance sheet stay in balance if he's got all his other assets are exactly the same and he hasn't really paid off any of his debt? How would the balance sheet be in balance? Is the account on the balance sheet that would be affected is the capital. Like I said to you, that capital account is basically very similar in nature to the business's net asset value. Or you could look at it in another way, as what the net asset value of the business is worth if you sold it. Or you could look at it as that is the amount of money that the business owes Bob as the owner of the business, that capital. And the capital account is the account that once a year, your accountant will actually transfer the net profit from your trading account to your capital account. After he's taken off, all the say non-cash transactions that he's going to put through, and he's put a provision aside for income tax. That profit that the business makes, the net profit that the business makes, is once a year your accountant will transfer that amount of money through to your capital account. And that then clears the trading account for that financial year. And at the start of the new financial year, in other words, 1st of January 2001, you're starting a brand new income statement. Obviously, the chances are pretty good that you're going to be running in last year's set of books at the same time as you're running in the new year's set of books, because it takes a couple of months generally, is to make sure you've got all of your transactions through in the previous financial year. All right. So very simply, that's all that's happening, is that when you're trading, the goal, the simplest goal of any business owner is to increase the amount of money they've got in the bank. But the reality is that as you're trading, you're going to be buying and selling stock. You might up your stock levels. You might buy another vehicle for distribution. There's a whole lot of possibilities of things that could happen that's actually been paid for by the profit you've made running your business. You know what you've got to remember is that each time you do any transaction in business, it's affecting a whole lot of things in your balance sheet. You're either paying money to buy stock, or you're selling some of your stock for cash. Each time your bank balance is changing, or you're buying on credit from a supplier, or you're selling on credit to one of your customers. Each time you do a transaction, things are changing. So again, what I'm going to do is go through to my laptop and let's put some numbers down that you can look at. Thank you. Right, so we're sitting looking at my laptop and we're talking about the income statement. Very first thing that I must say to you is that an income statement or trading account or profit and loss account, whatever you want to call it, is a report describing the results of your trading of your business over a certain time period. Traditionally, that time period is a year, and that really is for the taxman in your country to be able to assess how much tax your business must pay for that financial year. But for your own self, running your own business, you need to run your income statement much more often than each year. Really, if you look at it sensibly, is you don't need to trade for a whole year and then run your income statement to find out whether you've actually made a profit or a loss in your business. You should run it in your own business at least on a monthly basis after making sure that you've put through all of your expenses relating to that month. Because as most people would actually only put into their expenses when they actually pay them. Let's just look at, I made up a very simple income statement. This is for Bob's business, okay? And I've said there for the year ended 31st December 2001. So the balance sheet that we looked at in the previous video was as at 31st December 2000. Now we're taking Bob's business forward 1 year. And on the right-hand side, I've got the sales. Another word for it is turnover. And I've put through a number of $200,000. If you think about it logically, I've said to you in the first video that when you make a sales, your entry is a cash sale. It's debit, bank, credit sales. Sales on the credit side. What's happening with your income statement is it is a summary of your trading over a period of time. And if you think about it logically, that if you just bought stock, say $10,000 worth of stock each time, and you went and you sold that $10,000 worth of stock for $20,000, and then you bought another $10,000 worth of stock, and again sold it for $20,000. So what's happening is you're just putting money into your bank account, and it's slowly increasing because your selling price is double your cost price. That would be a fantastic business for anybody to have if that's all that ever happened, because you'd be watching your bank balance growing and growing and growing. And that, at the end of the day, is what everybody wants. in a business. You just want to see your bank balance going up. That's fantastic. But how would your balance sheet stay in balance? The only way that it can stay in balance is by your income statement. The net profit is affecting the capital in your balance sheet. If you make a profit in your income statement, it's going to increase the capital on your balance sheet. And if you make a loss in your income statement, it's going to decrease the value of your capital. You know, each time you do any transaction, is you're affecting something on your balance sheet. So the reality of trading is that your numbers in your balance sheets are actually changing with each transaction. And at the end, after your accountant has been through and looked at your books and done whatever he needs to do to actually assess what your net profit is, he's going to do a transaction that's going to transfer that net profit through to your capital and clear this income statement, so that on the 1st of January 2002, you're starting with an absolutely brand new income statement where all the numbers are zero. So on the debit side there, I'm saying that we've got cost of sales of 100,000. So that's half or 50% of your sales amount. Or you can look at it another way and say, my cost of sales is $100,000. My markup is 100%. There's a difference going from the cost of sales to sales. That's called a markup. Or going from sales to your cost of sales. That's your gross profit. That's a small technical thing. So what we're saying in this income statement is that the gross profit is sitting there at $100,000. And I've put a line underneath there that's saying contribution, $100,000. Now, that number, that word contribution, is saying how much money has the physical sale of your stock brought into your business to then help you pay on a monthly basis all of the expenses that you incur. For instance, I've put there the salaries, electricity, fuel. There might be rent. I'm missing out things like bond repayments, vehicle finance, etc., etc., etc. I'm just trying to keep this very simple at the moment. But that contribution in dollar terms is the most important number that you as a business owner or manager or whatever gets to work with and to influence, to try and make your business make as much money as possible. The dollar amount is much more important than percentages. And a lot of businesses, they will sit there and say to you, I'm talking fast foods, for instance, where your cost of sales, they want it to be kept as low as possible. But sometimes when you're keeping your cost of sales so small, such a small percentage, you don't get the sales because people can go somewhere else to buy something very similar that's cheaper, better value for money. And really going forward with these videos, everything that we're going to be looking at, because these numbers, sales and the cost of sales, are the two numbers that you can influence the most as a business owner to make yourself make more money. This contribution that you're getting there in dollar terms is absolutely everything when you're running your own business. It's absolutely, so we're going to go through into it in much more detail. And that's going to be everything that I'm going to be covering going forward. This is, like I said, it's just a summary. So what we've sat there, just the expenses that I've listed add up to 65,000. And we take that away from the gross profit or the contribution. We get a net profit of $35,000. All right, let's just go back and we just look at the balance sheets at the 31st of December of 2000. These were the numbers that I gave you in the previous video. Okay. And like I've just said to you, when we're trading, we're affecting these numbers all of the time. And your net profit is going to be added to your capital to keep this balance sheet in balance. I'm bringing up a new concept now, and it's called the trial balance. As at 31st December 2001. And if you look at this on the credit side, on the right-hand side, you've got balance sheet items, capital, bonds, for the land and buildings, vehicle finance, creditors. Those are all balance sheet items. And then we've got sales, which is an income statement or trading account item. Then on the debit side, we've got the balance sheet items, land and buildings, plant and machinery, vehicle, bank, stock, debtors. Those are all balance sheet accounts. And then we've got cost of sales, salaries, electricity, fuel. I've brought through the same numbers from the previous slide. Those are income statement accounts. So this trial balance, everything will always be in balance. There's no number there that says net profit. It's covered between what your sales are and then your cost of sales, salaries, electricity, and fuel is automatically, the net profit is sitting there. And between those numbers, that's keeping your whole trial balance in balance. And when you print out a balance sheet, you're going to drop all of the income statement accounts. And what will happen is that your net profit will transfer through automatically to your capital account to keep just the balance sheet in balance. And what I've shown you here, I've just put an arbitrary numbering system. That's more for people that when you look at a trial balance, you can automatically see whether an account is a balance sheet account or an income statement account. How I've done it here is I've numbered all of your accounts from say 100 to 999. Obviously, if you've got more accounts in your books for your business, you could start at 1,000 and go up to 9,999. But from say 100 to 499 would be balance sheet items. And from 500 to 999 would be income statement accounts. Okay, that's really for people, just to help people realize whether it's a balance sheet or an income statement account. Let's just go through. I've just summarized here what the trial balance is. So I'm sitting there saying to you as very simply as all your general ledger accounts, that they're both balance sheet and income statement accounts. So I've just explained that you've got a logical numbering system. Okay. Balance sheet from, I've put the 001 to 499 and the income statement from 500 to 999. But what I want to explain to you at this point is, with computerized accounting systems, when you create a set of accounts, your accounting system will automatically do this for you. They'll base the set of accounts on certain questions that they ask you. They'll want to know whether you're running want to run a livestock system. A livestock system means that when you sell an item, the system automatically takes that item out of your stock on the balance sheet and puts it through to your cost of sales account at average cost. This is an extremely important point to understand. You know, in the old days, if you wanted to work out the cost of sales in your business, at the end of each financial year, you'd stop your whole business to run a massive stock count. And say at the 31st of December, the year 2000, you would have counted all of the stock and you would have come up with the number that you had. Then your processing, your clerks that are doing the processing, they would just process each stock purchase. And you would add up for the whole year all of your stock purchases. And on the 31st of December of 2001, you close down your whole business to go and count all of your stock that you got on hand then. And your cost of sales would be calculated by opening stock plus purchases minus closing stock. Gives you your cost of sales. But with a computerized accounting system, these transactions are automatically being generated for you. And I'm going to come back to it later. But each time you do a sales transaction, it's doing an entry behind the scenes that's putting the transaction through for your cost of sales. What I've just put there as well, when you create new accounts, it's going to be always happening in your business. You might open another bank account. And if you open another bank account, you have to tell your accounting system that it is a bank account. You need to be able to use a cash book with it. If it's basically an accounting system is fairly dumb. And so you have to tell the accounting system each time you create an account what kind of account you're creating. And like I've just sort of explained to you with the cost of sales, transactions will happen behind the scenes automatically. And they will only happen correctly if you create the general ledger accounts correctly. Okay, so obviously the very first thing is you telling your accounting system each time you create an account, is it a balance sheet account or an income statement account? And then you've got to specify. And I've just been talking to you about the cost of sales. So your system also creates transaction types. So that can automatically do the entries in the background that make your accounting entries complete. So I've just talked to you about when you're selling an item. Let's say it's cash. You're going to debit your bank, credit your sales. But your accounting system is actually going to automatically generate another entry. And it's going to debit your cost of sales in your income statement. And it's going to credit your stock account in your balance sheet at the average cost of that item that has just been sold. So I'm going to go into this in a little bit more detail as we go further. All right, I've gone through to the next slide, which is Bob's business's balance sheet as at the 31st of December 2001. So this is a year later from what we looked at in the previous video. And I've brought through that net profit of $35,000. I've called it retained income. It's sitting there separately, but it's underneath your capital, just to reinforce the fact that I've brought through the net profit. But it's standard accounting practice that. What I've done, I haven't fiddled with anything under fixed assets or long-term liabilities. I've left all those numbers the same as if you haven't paid any of the normal standard repayments that you would make on a monthly basis, but we can come back to that later. I'm keeping it as simple as possible at the moment. So what I have changed, are all of your numbers under the current assets and current liabilities. So just arbitrarily, I've changed bank stock, and I've brought in debtors, people that owe you money, people that you've sold to, that will pay you in 30 days or whatever amount it is. Plus, I've increased your creditors slightly. I'm just trying to make it fairly realistic, but on a thumbsuck basis of numbers that you would see. All right, so I'm just showing you really that as you've traded, numbers in your balance sheets have changed. Right, so I've just brought through the income statement that we looked at just now. Again, just so that you can look at it again. You know, really why I just brought it through again quickly is just to reinforce the numbers that I put in there. Because what I'm saying to you on this slide is, what is the income statement telling you? And this is very important. Everything is very important. You must look at the income statement in conjunction with your balance sheet. You can't just look at your income statement, oh wow, I've made this amount of money, I'm a hero. You know, you could invest your capital, say, in a bank account to earn interest, and you could go and work for someone else instead of running your own business. So you're earning a salary. Your business needs to be making you a justifiable amount of money to actually run your own business. If you're not making enough money to justify the risk and everything like that, why run your own business? No, sure, it takes a bit of time to get a business going, and that first year you might live quite hard. I know a lot of people that have actually very discreetly lived within their own business premises just to get a business going, so that you're not spending money, you know, on your own apartment or anything like that. It really, a business needs to make enough money to justify you running it. You know, I said in this case as well, the cost of sales is 50% of your sales, or your markup on your stock to get your sales prices is 100%. Please just look at that. It's always like that. The percentages are different when you're going up compared to when you're going down. And I'm sitting there saying sales and cost of sales are the two areas that we are going to concentrate on, because they are the two numbers that have the biggest impact on how successful your business is. You know, what I never specified, and it is very important, is all of your expenses, like your salaries and fuel. You could have rent, whatever the story is. You must be sensible about how much money you're spending on all of those expenses. That's really all that I'm going to say at the moment. I can come back to that in more detail in future videos, but I'm going to be concentrating on your sales and your cost of sales with these videos. And then I'm giving you some advice as well. I've been there and done it, bought the t-shirt, is always pay yourself a salary through your business, so that your own salary comes there in the expenses in that salaries account. So I've written here that there is a tax benefit, and it helps you get personal credit. Now, the tax benefit is when you start a business, you might be paying yourself the smallest salary that you can possibly exist on. And your tax rate for a very small salary is going to be, in most countries, a lot lower than your tax rate for your business. So obviously it makes sense for you to pay yourself a salary, and you can increase that salary as your business is making more and more money, up until the point where the percentage tax that you're paying on your salary is the same as the tax that your business pays. So up until that point has been beneficial tax-wise to earn a salary through your business. But as soon as, if it happens in your country, that your income tax on your personal income, in other words, the salary, becomes more than your business tax rate, you've got to draw money out of your capital of the business. From then onwards, you don't pay yourself a salary anymore. You start just drawing money as an owner of the business, because then it's better for your business to be paying tax on the profit that your business makes. And I've also said to you, if you're getting a pay slip every month with your salary, and that money is going into your bank account as every single other employee in your business, it also helps you to get personal credit, because you've got this income record that any normal person has that works for anybody else. So there's definitely two seriously big benefits out of just paying yourself a salary. Right, I've given you like an overview of what's happening in the income statement. But now I just want to show you, I said to you that I would come back to this, is how does a sales transaction actually work? If we sell something for $1,000, all right, I've said there it's debit the cash or a debtor if we're giving them credit, and we're crediting sales of $1,000. So that, I've said, is what you actually see when an invoice is made. You know, that's happening if you had a cash register, a pay point, and like a hardware store, whatever it is. But I'm coming back to what's going on behind the scenes, and I'm helping you understand what these transaction types do. If you're running a live or integrated stock system, and if you're dealing with stock, there is no point whatsoever in not doing this. Is you have to do this, because your computer system, your accounting system, generates the second part of the record, the second transaction automatically. Okay, and what it's doing there is it's debiting the cost of sale. I'm saying we've got a markup of 100% or a gross profit of 50%. It's debiting the cost of sales that's in your income statement by $500, and it's crediting your stock by $500. It's reducing your stock. So it's automatically, you don't see that transaction. So any person at a cash register or any person sitting making an invoice at their computer doesn't even know that that transaction is happening, but it is happening, and it's critical, because what it's doing, it's keeping your stock levels at the correct theoretical quantity all of the time. And I'm saying to you, we will come back to this in more detail. And here I've just highlighted it again. This wasn't possible before computers, because I put it in writing for you, how you would have done it before computers. As cost of sales equals your opening balance plus purchases minus your closing balance. And you had to do a full manual stock count to get that. What is so important by having a live or integrated stock system is at any point in time, you can send a staff member or go yourself and count a specific item and compare it to your theoretical quantity at absolutely any point in time, as bringing in stock control. Like I say, we will come back to that in much more detail. It is critical in your business. I've just want to, at this point, bring up VAT, value-added tax. I think most countries have some form of VAT, and I think it works a fairly similar manner in most countries. The actual VAT percentages will be different in different countries, but the principle of how it works is very similar. And I just want to explain at this point is what actually happens in your books with VAT, so that you can understand it. I'm saying that it's probably the fairest form of taxation in the world. In effect, you can put different tax rates or VAT percentages on different items. So in some countries, like for instance, our country, your basic goods are zero VAT rated, 0%. Your basic, that's to keep the poor people buying food, for instance. And then we've got a 15% VAT rate over basically everything else. In other countries, very expensive items, they could up the VAT percentage to even higher. So you're helping the poor people by not charging VAT, and you're charging the rich people. If they want to go out and buy expensive things, then they pay a higher VAT percentage. And basically, there's two kinds of VAT when you're running a business. Is what is called input VAT, and that's generated when you are purchasing stock or anything else, actually any expense, unless it's zero rated with VAT. And your output VAT is generated by your sales. Okay, all you are really doing as a business owner is you're acting as an agent regarding VAT for your taxman. And when you're paying out money, you're buying, you're handing over your money to another VAT vendor to keep it for your taxman. And when you are selling your stock and you are charging VAT, you are receiving that VAT from your customer, which you keep in your bank account, acting only as an agent for your taxman in your country. So I've given you the two entries there. Is when you're buying stock, and I'm working on a VAT percentage of 10%, you bring your stock into your books at a price that excludes VAT. The numbers are a little bit small for me, but basically I've debited stock at an amount of money. I've debited VAT at 10% of that amount of money, and then I'm crediting either your bank because you paid cash or your supplier with the two amounts added up because it includes VAT. And when you sell, you get all that money with the VAT into your bank account. But the number that goes through sales is excluding VAT. And your VAT has gone through to your VAT account. So really what happens is in your general ledger is you've got an account called VAT. And when you pay for anything, any expense, or you buy stock, your VAT account is in your general ledger is going to be debited with that amount of money. And when you sell your product your VAT account is going to be credited with however much VAT was included in the transaction. And if you're making a profit and you're VAT registered vendor, the credit side should always be bigger than the debit side. You would normally always be owing your tax collector the VAT, the difference between the VAT you've paid out and the VAT that you've collected on your taxman's behalf. So all you're doing is you're acting as an agent. There's nowhere else in the book, in your books of your business, does it show anything to do with VAT, excepting in that VAT account. And that is how VAT is handled. All right, we're coming to the end of this module. So what I'm sitting and saying is, what have we covered so far? All right. And I'm telling you that the balance sheet and income statement are your two fundamental accounting reports. And I'm saying you can run them as often as you want to, and you should run them at least once a month. The balance sheet is at a specific point in time. The income statement is for a period of time, a month or a year, whatever. And I'm saying that you must look at them together. However, as they stand, even though I have showed you very simplistic reports, they are only giving you an overview of your business. All that your income statement is doing is saying, have you made a profit or a loss? And if you made a profit, how big is that profit? It's not telling you how you actually made that money, where the money came from in your operations. All right. So they're not drilling down into the actual operations of your business to give you information that assists you in making good business decisions. So that is what we're going to cover going forward, is we're going to learn how to drill in. Now, the next video I'm going to make will be quite a small one. It's just to cover cash flow. Cash flow doesn't make you any profit, but it keeps the doors open. It's absolutely critical in business. And then we will look at stock and depth. And when we look in stock and depth, that's when we're going to be looking at your cost of sales and your sales. And that's when we're going to be drilling into what's actually happening in your business finances. Right. Thank you very much for watching.